Ever dream of ditching the 9 to 5 grind years or even decades ahead of schedule? Trading in your commute for a hammock, a passion project, or simply the freedom to live life on your own terms? It might sound like a fantasy, but for many, it's a reality achieved through one powerful strategy: smart investing for early retirement. This isn't about getting lucky with a hot stock tip. It's about building a disciplined, long-term plan that puts your money to work for you. Today, we're going to break down the exact steps you can take to build your own path to financial independence and retire early. It's more achievable than you think. So, let's get started. First things first, you need to define what early retirement means to you. Is it retiring at 55, 45, or even 35? Your target age is the cornerstone of your entire plan. Once you have that number, you need to figure out your FIRE number. FIRE stands for Financial Independence, Retire Early. This is the total amount of money you need to have invested to live off the returns indefinitely without ever having to work again. A common rule of thumb is the 4% rule. It suggests you can safely withdraw 4% of your total investments each year without depleting your principal. So, to find your FIRE number, simply multiply your desired annual spending in retirement by 25. For example, if you think you'll need $50,000 a year to live comfortably, your FIRE number is $50,000 times 25, which is $1,025 million. That might sound like a huge number, but don't be intimidated. We're going to break down how to get there. The single most powerful engine for wealth creation is your savings rate. This is the percentage of your after-tax income that you save and invest. To retire early, you need to think beyond the traditional 10-15% savings advice. Early retirees often save 30%, 40%, or even 50% or more of their income. Now, how do you do that? It starts with a deep dive into your budget. Track every single dollar for a month or two. You'll be amazed at where your money is actually going. Identify the big three expenses: housing, transportation, and food. Making significant cuts in these areas will have a much bigger impact than skipping your daily latte. Could you downsize your home, live with a roommate, or move to a lower cost of living area? Could you switch to a more fuel-efficient car? Or better yet, rely on public transport or a bike? Meal prepping and eating out less can also free up hundreds of dollars each month. Every dollar you don't spend is a dollar you can invest to buy your freedom sooner. Once you've supercharged your savings rate, the next question is where to put that money. Just letting it sit in a savings account won't work. Inflation will eat away at its value over time. You need to invest. For most people building wealth for early retirement, the foundation of their portfolio will be low-cost index funds or ETFs. These funds are fantastic because they give you instant diversification. Instead of trying to pick individual winning stocks, you're buying a small piece of the entire market, like the S&P 500, which tracks the 500 largest companies in the U.S. This strategy is simple, effective, and has historically provided solid returns over the long term, averaging around 8 to 10% annually. It has the set it and forget it approach that allows your money to grow through the power of compound interest without you having to constantly monitor the stock market. Now, let's talk about the accounts you should be using. It's crucial to take advantage of tax-advantaged retirement accounts before investing in a standard brokerage account. In the U.S., this means maximizing contributions to your 401k, especially if your employer offers a match. That's free money. After that, look into a Roth IRA. With a Roth IRA, you contribute after-tax dollars, but your investments grow completely tax-free, and all your qualified withdrawals in retirement are also tax-free. This is incredibly powerful for an early retiree. If you've maxed out both your 401k and IRA, then you can start putting additional funds into a taxable brokerage account. The key is to be strategic about using these accounts to minimize your tax burden, both now and in the future. Let's talk about a concept that can turbocharge your journey: increasing your income. While cutting expenses is crucial, there's a limit to how much you can cut. There is, however, no limit to how much you can earn. Think about ways to boost your income and funnel that extra cash directly into your investments. This could mean asking for a raise at your current job, developing new skills to move into a higher-paying role, or starting a side hustle. Whether it's freelance writing, dog walking, managing social media for small businesses, or selling crafts online, a side hustle can dramatically increase your savings rate. If you can earn an extra $500 a month and invest all of it, that's an additional $6,000 a year working towards your freedom. Over a decade, that's a significant boost to your portfolio. As your investments grow, it's essential to stay the course. The stock market will have ups and downs. There will be scary headlines and market crashes. This is normal. The worst thing you can do during a downturn is panic and sell your investments. History has shown that the market always recovers and goes on to reach new highs. Selling when the market is low just locks in your losses. Instead, see market dips as a buying opportunity. Stocks are on sale. By continuing to invest consistently every month, a strategy known as dollar cost averaging, you'll actually buy more shares when prices are low. Remember, investing for early retirement is a marathon, not a sprint. Your emotional discipline will be just as important as your financial discipline. As you get closer to your target retirement date, say within 5 to 10 years, you might want to adjust your strategy slightly. While you still need growth, you'll also want to start preserving the wealth you've built. This often means gradually shifting your asset allocation to be a bit more conservative. You might reduce your percentage of stocks and increase your holdings in less volatile assets like bonds. This helps cushion your portfolio against a sudden market drop right before you plan to stop working. You don't want a market crash to delay your retirement by several years. It's about finding a balance between continued growth and capital preservation as you approach the finish line. Finally, remember that financial independence is not just about the numbers. It's about designing a life you're excited to live. What will you do with your newfound freedom? Travel the world? Volunteer for a cause you're passionate about? Spend more time with family? Start a business you've always dreamed of? Having a clear vision for your post-work life will keep you motivated on the days when saving feels like a sacrifice. This journey is about buying back your most valuable asset, your time. So, to recap, define your why and calculate your FIRE number. Aggressively increase your savings rate by cutting expenses. Invest consistently in low-cost index funds, making sure to max out your tax-advantaged accounts first. Look for ways to increase your income and stay disciplined during market volatility. By following these steps, you can turn the dream of early retirement into your reality. It takes discipline, it takes a plan, and it takes patience, but the freedom you gain is worth every bit of the effort. Thank you so much for watching. If you found this video helpful, please give it a thumbs up. And don't forget to subscribe to the channel for more content on personal finance and investing. We'd love to hear your thoughts or questions in the comments below. See you in the next video.